Welcome to another bar walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over bar area 2. This is section G. This is an application topic. Calculate foreign currency translation adjustments, such as local currency to functional currency and or functional currency to reporting currency to prepare consolidated financial statements. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to superfastcpa.com and sign up for our free 1-hour webinar training. In that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time failing exams. And after you watch that, you're going to want to learn more, so make sure you also check out becoming a SuperfastCPA Pro member. Pro members get access to a lot of great stuff, including the Pro course where Nate explains in detail, kind of like a much more in-depth version of the 1-hour webinar, how to pass the CPA exams. So again, it's a much more in-depth version of the 1-hour webinar. And Pro course members also get access to the full versions of these walkthrough videos. Now, to be honest, in today's video, we are only going over 5 questions for the YouTube version and for the member version because this seems to be a topic that is a little bit smaller, but it's still something that's important for you to know. So we're going to go over 5 questions for YouTube and for the member version. But typically the member versions have 10 questions, or basically double the questions that the YouTube versions have, so that they can get a little bit more help and a little bit more understanding. So if you like this video and you like our other videos, make sure you check out becoming a SuperfastCPA Pro member. Now with all that said, let's dive straight into the questions for this video. All right, here we are at question 1, and something I always like to point out when it's an option is you want to read the last sentence of a question first. This is a very good strategy for the whole process, but especially for taking the exam. When you're at the exam, you want to do whatever it takes to get through the exam as quickly as possible while also still doing well. And a really good strategy is reading the last sentence first because it gives you context for what the rest of the question is about. And this will be really helpful in moving through the exam quickly. So let's do that here. Which currency is most likely the functional currency of the subsidiary, and what type of exchange rate should Zabra use to translate the subsidiary's financial statements? Let's go up to the top. A foreign subsidiary of Zabra Corp operates in Canada, where it uses Canadian dollars, or CAD, for daily operations. The subsidiary maintains its books in Canadian dollars. Zabra Corp is a US-based parent and prepares consolidated financial statements in US dollars. So again, which currency is most likely the foreign currency here, and what exchange rate are they going to use to translate the subsidiary's financial statements? Now, if you watched the previous video where we talked about foreign currency concepts, then you have an idea of some of this. But if you don't know the answer to this, that's okay. We are going to use this question to start learning. So let's go ahead and dive into the explanation. All right, here we are. The answer is D. Functional currency is the Canadian dollar, and you use the current rate method to translate it. So let's walk through this. We talked a little bit about this in the previous video again, but let's do it here some more. Since the subsidiary operates primarily in Canada and uses Canadian dollars in its day-to-day operations, the functional currency is Canadian dollars. Because the functional currency is not the same as the reporting currency, the United States dollar, Zabra must translate the subsidiary's financial statements into the US dollar using the current rate method. Under this method, assets and liabilities are translated at the current exchange rate, equity is translated at historical rates, revenues and expenses are translated at the average rate, and the resulting translation adjustment is reported in OCI, not net income. And again, this is somewhat similar to what we talked about in the previous video. This is kind of almost a refresher. So again, when you're translating the functional currency to the reporting currency, you're using the current method. And again, this is how you do it. You have assets and liabilities using the current exchange rate, equity using historical rate, revenues and expenses using the average rate. And this goes to OCI. All right, so that was a little bit of a review / something new. Now let's go to the next question. Okay, here we are at question 2. What amount should the parent report as the foreign currency translation adjustment in other comprehensive income, OCI, for the year? Let's go up to the top. A U.S. parent owns a foreign subsidiary whose functional currency is the local currency, just LC. So in this case, it's just local currency. We're not sure what that is. The subsidiary's net assets increased from LC 100,000 at the beginning of the year to LC 120,000 at the end of the year. No dividends were paid and no capital contributions occurred during the year. The relevant exchange rates are at the beginning of the year, 1 local currency equals 80 cents. End of the year, 1 local currency equals 90 cents, and the average rate for the year is, between the two is 85 cents. So again, what amount should the parent report as the foreign currency translation adjustment in other comprehensive income for the year? So we just talked about this in question 1. What rate are we going to be using? Pause the video, think about this, and when you're ready to come back, we'll look at this and learn a little bit more. Okay, here we are. The answer is B, $11,000 gain. And again, this is going to go to OCI, so let's talk about this. Because the foreign subsidiary's functional currency is the local currency, the parent uses the current rate method to translate the subsidiary's financial statements into US dollars. Because again, if the functional currency, the local currency, isn't the same as the reporting currency, you have to translate it. Under this method, the assets and liabilities are translated at the current, and that's the end of the year rate. Equity is translated at the historical rates, and revenues and expenses are translated at the average rate. So therefore, we are going to use the average rate. So we're going to do this translation adjustment. First, we translate the beginning net assets using the beginning rate. So that's the local currency, 100,000 multiplied by 80 cents per local currency. That's $80,000. Then we translate the ending net assets using the ending rate or the current rate, and that's 90 cents multiplied by 120,000 local currencies, and that's $108,000. And then finally, we calculate the change in net assets from operations. So there was a change in the local currency of 20,000. So we take that change and multiply it by the average rate, and that gives us $17,000. So the translation adjustment ends up being $108,000 less $80,000 less $17,000, giving us an $11,000 gain. So again, the $11,000 foreign currency translation gain is reported in other comprehensive income. And this is a translation gain because over time, because of the change in the exchange rate, they are going to recognize an $11,000 gain from the changes in the exchange rate. So with that, let's go to the next question. All right, here we are at question 3. Using the temporal method, what is the remeasured USD value of total assets at 12/31? Let's go up to the top. Mora Inc., a US-based parent company, owns a foreign subsidiary located in a country with an unstable economy. Because the subsidiary operates in a hyperinflationary economy, its functional currency is the US dollar. Selected year-end trial balance amounts in the local currency are cash, that's monetary, that's local currency $20,000, inventory, which was purchased evenly throughout the year, local currency $50,000, and then equipment acquired 2 years ago, local currency $80,000. And the applicable exchange rates, so this is kind of similar to question 2. Historical rate for inventory purchases, 1 local currency equals 50 cents. Historical rate for equipment purchase is 1 LC equals 40 cents. And the current rate, which was at the year end, is 1 local currency equals 60 cents. And the average rate throughout the year is 55 cents. So assume these are the subsidiary's only assets. Again, using the temporal method, what is the remeasured United States dollar value of total assets at 12/31? Now, if you have no idea what the temporal method is, we talked about the current method a little bit in question 1, but if you have no idea what the temporal method is, that's okay. We're going to walk through it and learn what we're doing here for this remeasurement. So if you want, pause the video and think through this, but if not, let's go ahead and take a look at the answer together. All right, here we are at the answer, A, $69,000. So let's walk through this. Because the functional currency is the US dollar and the subsidiary keeps its books in the local currency, Mora Inc. must apply the temporal method to remeasure the subsidiary's financial statements into US dollars. So just as a reminder, that there's a difference between the temporal method and the current method, or really there's a difference between remeasurement and translation. Remeasurement, you're getting the functional currency into the reporting currency. So what do we do here? When we use the temporal method, we have the monetary assets and liabilities, such as cash, accounts payable, and they are remeasured at the current exchange rate. And then the non-monetary items like inventory and equipment are remeasured at the historical rate based on when the asset was acquired. So now we can figure out what the remeasurement is of the total assets. So first we start with the cash. That's a monetary item, so we use the current exchange rate. So local currency 20,000 multiplied by 60 cents equals $12,000. Inventory, which was a non-monetary item, you use the historical rate. That's local currency 50,000 multiplied by 50 cents. That's $25,000. And then equipment, also a non-monetary item. That's the historical rate. Multiply 80,000 local currency multiplied by 40% equals $32,000. So the total remeasured assets is $69,000. Any resulting remeasurement gain or loss flows through net income, unlike translation adjustments which go to OCI under the current rate method. So again, when they remeasure this, they're remeasuring it from local currency into US dollars, and they are remeasuring it into US dollars of $69,000. And any remeasurement gain from this flows to net income, not OCI, unlike with translations where it goes to OCI. Now with that, let's go to the next question. Okay, here we are at question 4. Assuming the subsidiary had a net asset position throughout the year and no capital changes occurred, which of the following is the most likely effect on the U.S. parent's consolidated financial statements? Let's go up to the top. A U.S. parent company uses the current rate method to translate the financial statements of a foreign subsidiary using whose functional currency is the local currency. During the year, the local currency strengthened significantly against the U.S. dollar. So again, let's assume they had a net position throughout the year and no capital changes occurred. Which of the following is the most likely effect on the U.S. parent's consolidated financial statements? Let's walk through this. Option A, a remeasurement loss is reported in net income. Option B, a translation gain is reported in other comprehensive income. Option C, a translation loss is reported in OCI. Or option D, no translation adjustment is necessary under the current rate method. So based on what we've learned so far, you might have an idea. If you don't, if you're still a little bit confused, that's okay. We're going to use this question to learn some more. But if you want, give this a try, and when you're ready, come back. We'll look at the answer together. All right, here we are at the answer. B, a translation gain is reported in other comprehensive income. So let's go through this. Under the current rate method, again, we talked about this in question 1, which is used when the functional currency does not equal the reporting currency. Changes in exchange rates impact the translation adjustment, which is reported in OCI. When the foreign functional currency appreciates against the reporting currency, the United States dollar, the US dollar value of the subsidiary's net assets increases. This results in a translation gain reported in OCI, not in net income. Monetary and non-monetary assets and liabilities are retranslated at the current rate. Net asset increases in United States dollar terms from appreciation are recognized in OCI as part of the cumulative translation adjustment. So we learned a little bit more there. Now let's go to the next question. All right, here we are at question 5. Which currency is most likely the functional currency of the subsidiary? And again, this is kind of recalling back to what we talked about in the previous video, so this is very similar. Ladora Inc., a US-based parent company, owns a foreign manufacturing subsidiary that operates in Southeast Asia. The subsidiary uses the following currencies in its business: local currency, used for paying most employee wages and facility expenses; euros, used for purchasing raw materials from European suppliers; and US dollars, used to price and sell its finished goods, which are primarily exported to the United States. All intercompany financing is also denominated in US dollars. So again, which currency is most likely the functional currency of the subsidiary? Now, based on what we've learned in this video, and if you watched the previous video, you might know the answer. Think about this, and when you're ready, come back and we'll look at the answer together. All right, here we are at the answer, US dollar. That's option C. The functional currency is the currency of the primary economic environment in which the entity operates. This is typically the currency that primarily influences sales prices for goods and services, primarily influences costs of labor, materials, and other inputs, and is used for financing and cash flows. In this case, although the local currency is used for operating expenses like wages, it is not the main currency for sales or financing. The euro is only used for sourcing materials and does not reflect the primary business activity. The US dollar is used for pricing and selling finished goods, that's the revenue, and for all intercompany financing. Because sales and financing dominate and both are denominated in US dollars, the USD is the most likely functional currency in this situation. So a little bit different than what we saw in the previous video. But again, we are seeing there that, depending on the circumstance, doesn't always have to be the local currency, or it frequently can be the local currency. You just need to pay attention to the circumstances. Now with that, we learned quite a few things in these 5 questions. Before we do anything else, let's do one more part of the SuperfastCPA CPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up. You've seen 2 or 3 questions trying to teach you about how to figure out what the functional currency is, or about how to use the current method, or about translation, or about remeasurement. Whatever you're seeing in the questions, most frequently, you can tell that those are the pillar topics and the things you need to know because they are the things that are coming up the most. So you take a moment and write these things out as the most important things you learned from the questions, and that way you are ready for the exam when you get to the exam because you already know what the most important things you need to know are from pulling out the pillar topics. So let's go ahead and take a look at the pillar topics for this video. All right, here we are at the pillar topics. Let's just go through this. Use the current rate method when the functional currency is different from the reporting currency. Translation adjustments are reported in OCI. To calculate a translation adjustment, translate beginning and ending net assets at their respective exchange rates and compare the change to operational activity translated at the average rate. Under the temporal method, so that's different than the current rate method. Under the temporal method, monetary items are remeasured at the current rate, while non-monetary items like inventory and equipment use historical exchange rates. If the functional currency appreciates against the reporting currency, a translation gain occurs and it's recognized in OCI under the current rate method. The functional currency is the one that reflects the primary economic environment, typically determined by the currency that influences sales and financing decisions. So again, with that, we've gone over the pillar topics for this video, and that is the end of the YouTube version of this video. And remember, in today's video, we're only going over 5 questions for YouTube and for members, but typically pro members get access to the full 10 question versions of these videos. So if you like this and you like our other videos, make sure you check out becoming a SuperfastCPA Pro member because they get access again to the full versions of these videos and they get access to the pro course and a lot of awesome things. So check out becoming a pro member, and the easiest way to learn about and become a SuperfastCPA Pro member is by going to SuperfastCPA.com. Go to SuperfastCPA.com and sign up for our free 1-hour webinar training. We will teach you in that 1 hour the key ingredients to passing the CPA exam so you don't waste months failing the exams. And again, after that, you're going to have a better path to learning about and becoming a SuperfastCPA Pro member. So check out the webinar, check out becoming a pro member. If you liked today's video, make sure to like it and leave a comment. I hope it was helpful, and I will see you in the next video.